Plenty of people are pointing to homebuilder strength, especially this week, as a sign of economic momentum. But is it really even the best reflection of the overall housing market?
The United States is going through a phase right now where the cost of housing is expected to crash. It is predicted that home prices are to fall at least 50% this summer. What are the reasons for it, and what is happening in the housing sector? Keep watching this video to know more. Housing specialists are updating their initial predictions for 2023 to reflect a less optimistic outlook as they look towards the remainder of the year. Everyone wonders the same thing: when will things return to normal? Although there is no way to forecast the future, industry insiders have made the following predictions for the second half of 2023. Even though the summer has been extremely hot all across the nation, the housing market is still barely moving. The country's average 30-year fixed mortgage rate reached its lowest point in July, before moving closer to 7% in the first week of August. 1/10 of a percent point is referred to as a basis point. According to the National Association of Realtors, or NAR, monthly house sales decreased by 3.3%, with sales declining across the board in all 4 major US regions. In the meantime, the median price for existing homes rose beyond $400,000 for the first time in 2023, reaching $410,200, the second highest figure ever noted, and is currently on track to surpass the record-breaking high of $413,800, which was set in June 2022. What's fascinating is that despite these ever-rising mortgage rates, the market is nevertheless highly competitive because of high consumer demand and a limited supply of available properties, partly because homeowners who bought houses at historically cheap interest rates in recent years have decided to stay put. These and other elements combine to create ideal affordability problem storm that disadvantages many would-be homeowners. Due to high mortgage rates, rising home prices, and a limited housing supply, the housing market activity generally continues to be sluggish. This plethora of challenges is what's causing the housing affordability issue. High inflation and future interest rate increases are still a concern. Mortgage rates increased in the first week of July and peaked at 6.96% by the middle of the month, after the Federal Reserve's policymakers decided to raise the federal funds rate at their July meeting by the widely anticipated 25 basis points. The overnight lending rate between financial institutions is the federal funds rate. A Fed rate increase indirectly impacts long-term mortgages like 30-year fixed-rate mortgages. When the Fed started hiking rates in March 2022, the federal funds rate was essentially zero. There is currently a rate range of 5.25 to 5.5%. New terminal rate estimates from the Fed were released in June, and they indicate that the rate would increase by at least one more time in 2023 to 5.6% by the end of the year. As a result, many analysts predict that mortgage rates will stay above 6% for the rest of the year. What do you think is going to happen with these rates? It is difficult to imagine the housing market conditions significantly improving anytime soon, especially if the Fed continues with rate hikes. If the ongoing oscillation between 6.5% and 7% continues, or if rates break through 7% again. Weekly averages for 30-year mortgage rates are also down from their peak in fall 2022. According to a Freddie Mac study, mortgage originations totaled just $344 billion in the first quarter of 2023, the lowest amount since the second quarter of 2014. Housing industry specialists predict that originations will stay low for 2023. According to NAR, existing home sales were down a staggering 18.9% from the previous year. A major housing historical event was the housing meltdown of 2008. Since the number of new homes being built fell dramatically, there has been a problem with low housing inventory. In 2023, experts state that it won't have entirely recovered. Housing supply is still or close to historic lows, particularly for entry-level housing, which supports demand and keeps home prices high. Even yet, new single-family houses have been helping, at least partly, by luring interested buyers upset by the small selection construction of resale properties. Additionally, a further incentive drawing home buyers is the recent sharp reduction in the price differential between the median existing and new home sales prices. New house inventory is becoming competitive due to the low supply of existing homes, and new homes are now priced competitively. A new home that costs the median amount is currently only $5,000, which is more expensive than an old home. The typical sales price of a new home was $496,800 in October 2022, while the median sales price of an existing home was $378,800. This is an $18,000 difference. Since then, the difference has decreased by almost 96%. Existing inventory is restricted to a meager 3.1-month supply at the present sales pace, since the inventory of unsold existing residences remained stable between May and June. For months, available inventory has been stuck at all-time low levels. Data in the building sector was conflicting, indicating that some home builders' trepidation in the face of erratic changes in mortgage rates and other industry difficulties. At the same time, although more slowly, builder confidence is still increasing. The most recent NAHB, or Wells Fargo Housing Market Index, HMI, which measures builder sentiment, increased slightly from 55 to 56. The index hasn't reported a reading this high in over a year. A number of 50 or higher indicates that more builders anticipate favorable conditions for new buildings. Builders reduced their incentives for buyers in July, despite mortgage rates ranging at about 7%, as unsatisfied buyers constrained by a lack of available inventory continued to focus on new construction. Only 22% of builders offered price reductions in July, down from 25% in June to 27% in May. Another important aspect is the struggle with affordability sidelining aspiring home buyers. The country is facing a housing affordability crisis due to a lack of housing supply, stubbornly high mortgage rates, and sales prices that have slowly continued since February, despite signals that home prices are beginning to fall in some areas. According to NAR, the median existing home sales price increased from $396,000 to $410,200 in June, making it the second highest price ever and just 0.9% below the high of $413,800 from a year earlier. Those looking to purchase a home and continue to see the consequences of pandemic-driven housing price rise, combined with high borrowing rates even as inflation slows. Housing affordability is evident despite the growth in property prices and the average 30-year fixed loan rate, which is far above 6%. The current health of the US housing market was revealed in a new report by the National Association of Realtors. Home sales decreased by 23% and 20.4% in April and May respectively. For context, even a 20% decline in housing costs through 2023 would not return home values to their pre-pandemic levels. What is your take on all of this? Do let us know your predictions and whether the situation will continue in the comments section. With that, we have come to the end of our video. Don't forget to click subscribe and like, as well as share the video. Until next time.